Hello, my name is Eddie Tofpick. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn and Kansas City wheat. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of these patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Chicago wheat. One single pattern has been a cause of the rising prices here seen throughout July. A pattern I highlighted 2 weeks ago. It's a June and early July based diamond bottom pattern highlighted in bright pink on my daily chart. And the move up easily reached its primary and harder to reach secondary topside targets. Once we closed outside this pattern, we had a strong gapping move higher through the green short medium moving average, currently at 633.5. The 50% Fibonacci lines of the May 24 and May 25 move at 622.25, and the May 24 to May 25, March 24 to May 25 move at 651 even, plus the important 50% absolute Fibonacci line at 682. But we started to slow at the bright red neckline extension, which is currently at 710 even, of the small October to November 2020 head and shoulders top, plus the October 2013 high at 720.5. We finally halted at the March 2014 high at 725.25, though one could argue that it was the approach to either the connected high trend lines of March to date, which is currently at 735.75, or the bright green upper time, currently 741, and I would take either of these as being legitimate. The pullback lower today is seen set to make a pretty impressive, or has made a pretty impressive key reversal down, pushing below the 50% absolute Fibonacci line, but so far not managing to maintain the bearishness down there. I suspect we might see some more further base building, much as we saw earlier this week and late last week on the 50% absolute Fibonacci line. However, just in case the 50% absolute Fibonacci line does not hold up, I've drawn a new Fibonacci line for the recent action for the 50% move at 651 even. So that's the late June to early July move. And that should be one to watch, as it also fills in the gap left on the way up. Now, I have one more thing to say, and it's to deal with this rise as what is called a vertical run-up pattern. Such a move as we have seen, about 2 out of 10 times we see a further continuation higher, though not as swiftly. Most of the time, about 8 out of 10 times, we see a retracement of some or all of the run-up. A rough medium is about half the move up is retraced, with about 2 out of 10 times seeing a full retracement. However, the retracement is usually short-lived. A rough guide is about a month or so. The only exception is those that have seen a further continuation move higher, where it becomes problematic. This is worth considering here in this situation, also in the other grain markets as well. Chicago corn. The market from mid-May moved down in what was ultimately a bright red descending expanding wedge pattern until it reached a very, very substantial support. The dark blue May 2020 to date uptrend. That's right, a 6-year-old uptrend that still works. It's currently at 406.5. At this uptrend, the market formed a pipe bottom and rallied, really rallied, gapping rallied out of the descending expanding wedge pattern, easily reaching both the primary and secondary targets for this pattern, as well as through the 3 main moving averages. The gold long moving average currently at 449 even, green short medium moving average currently 448 even, and the mauve medium moving average currently at 456 even. In addition to these, prices overcame the pink lower trend line, currently 452.25, of the July 23 to January 2024 descending triangle, and the 50% Fibonacci line for the whole of 2025 at 454.75. So all in all, overcoming some pretty heavy duty resistances between 447.5 to 454 3/4, shooting all the way up to the congestion we saw back in May from the double top, Adam and Eve, between about 460 to 485 even. And over the purple neckline, currently at 473 3/4 of this double top, but finally pausing at a wide but somewhat sparse overhead congestion band between 490 to 490.5 to 497.5, containing the April 25 high at 497.5. I'm not sure if this move up is done yet, as today's action is not a big key reversal down as we've seen in the international grain markets, but here is a long-legged yet indecisive spinning top, but one that could also be seen as a key reversal up, if only by a little, but still up. Apart from the earlier mentioned congestion overhead, what I can say is this market was topped by another specific new piece of congestion, part of a new large pattern, and one I'm not entirely happy to draw yet today actually, and I'll explain why. You see, it's not the pattern I object to, but that I have to draw two patterns, as I'm not certain of which one will hold the market best. You see, today the market was capped by the bright green upper time, currently at 491 1/4 of the mid-August 25 to late June 26 bullish shift pitch hook. This is a good pattern, but as I'm not certain as just how good it is for this coming week, so I've also drawn a more acute dark blue bullish Andrews pitch hook for the same move. In this one, we are in between the dark blue middle time below, currently at 456 3/4, and the dark blue upper time above, which is currently at 502 3/4. And it's the dark blue upper time which seems to be the more important obstacle right now. That all being said, if prices do turn lower, then we have some resistances that are now supports, and ones already mentioned by me, plus three new ones, which is the dark blue middle time, the dark green middle time, which is currently 449 1/4, and a new 50% Fibonacci line for the late June to July move up at 449 even. Quite a lot around the 449 area indeed, as we have a gap left over between 440 1/4 to 458 3/4. Now, I have one more thing to say, something I've said in the grain markets, but it also applies here in corn, and it's to deal with this rise as what is called the vertical run-up pattern. In such a move up as we have seen, about 2 out of 10 times we see a further continuation higher, though not swiftly. Most of the time, 8 out of 10 times we see a retracement of some or all of the run up. A rough median is about half the move up is retraced, about 2 out of 10 times seeing a full retracement. However, the retracement is usually short-lived. A rough guide is about a month or so. The only exception is those that have seen that further continuation move higher, where it becomes problematic. This is worth considering here in this situation. Kansas City wheat. Much like Chicago wheat, one single pattern has been the cause of the rising prices seen here throughout July. A pattern I highlighted a few weeks ago, a late May to early July based diamond bottom pattern, highlighted in dark blue on my daily chart. And the gapping move up easily reached its primary and harder to reach secondary topside targets. Once we closed outside this pattern, we had a strong gapping move higher through the green short medium moving average, currently at 674 1/4. The 50% Fibonacci lines of the big old 2011-2019 move at 691 1/4, plus the important 50% absolute Fibonacci line at 697 1/4. But we started to slope the newly drawn dark blue upper time, currently at 785 1/2, of the mid-December 25 to late June 26 bullish shift pitch hook. This isn't the only pitch hook that I've drawn for this period, as I've also drawn, or should I say finessed, a bright red bullish Andrews pitch hook for the same move. So far this bright red pitch hook has not been impactful, but it is there nevertheless, as it seems that both these, especially I think the bright red Andrews pitch hook, seem to be more optimized fit than the one I drew last week, which was a bright red start of April to late June bullish Andrews pitch hook. There's also congestion dating from July 2023 up to 787 even and 790 3/4 that eroded the bullish incentive enough to cause what we have today, a possible pretty impressive, very large key reversal down. Now, the market had also today dropped down through some congestion between 760 to 764 1/2, containing the May 24 high at 760 even. However, we also started to slow its descent, and there are a number of supports to now look out for. Obviously, we have the bright red and dark blue middle tines, which are currently 726.5 and 703 3/4 respectively. Plus, just in case, I would also keep an eye on the pair of 50% Fibonacci lines mentioned earlier, and the new June to July 2026 50% Fibonacci line, which is nearby at 701 3/4, as well as the gap left on the way up further down between 678 3/4 to 690 even. Personally, I think maybe, just maybe, the bright red middle tines might show the more interesting support, but we shall see, though the gap below is one to watch. Now, I've one more thing I wish to say or to add to this, and it's to deal with this rise, as it's what's called a vertical run-up pattern. Such a move as we have seen, about 2 out of 10 times we see a further continuation higher, though not as swiftly. Most of the time, which is 8 out of 10 times, we see a retracement of some or all of the run-up. A rough medium is about half of the move up is retraced, with about 2 out of 10 times seeing a full retracement. However, the retracement is usually short-lived. A rough guide is about 2 months or so. The only exception is those that have seen a further continuation move higher, where it becomes problematic. This is worth considering here in this situation, and also in the other grain markets as well. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.